Welcome to Discovery Watch with John Kaiser.
I'm Jim Goddard. Welcome back to the show, John.
Jim, it's great to be back.
John, Cleantech just announced a Scandium offtake deal with Panasonic. Is this the breakthrough the market has been waiting for quite some time?
Jim, if you read it very quickly, this news release, you would say, wow, look at this. Panasonic, this big diversified company is teaming up with Cleantech to research applications involving Scandium, but they're also got an offtake agreement in their words like binding, and you sort of say, okay, but when you look closer at it, it's all sizzle and no steak. But it is still a very interesting development because Cleantech has not talked much about Scandium at all. Back in 2015, when they acquired the Sunrise project, Scandium was the original focus because the scandium-enriched portion of it is the richest and biggest scandium deposit in the world, and of this laterite type that exists in New South Wales. But they subsequently shifted their focus to the lower grade scandium portion, which is a nickel-cobalt resource, and developed or completed a definitive feasibility study in mid-2018, which had an over $1 billion capex. They raised almost $200 million, and it just barely made it at the cobalt and nickel prices at the time. But and scandium was supposed to be a byproduct as much as 75 tons per year, but cobalt fell 50% from the level that they were using in it, and nickel still hasn't really performed as they require. So this project is kind of stuck. It can't go forward until we have better nickel-cobalt prices. And because they can't permit two different mines on the same property, they can't just go back to the scandium-enriched part and put that into production as a scandium project. So even though Robert Friedland was very keen about scandium several years ago, at the annual meeting on October 31st in the presentation, there was not one mention of scandium at all. It was all about the decarbonized future, how Cleantech's going to be part of it, how nickel-cobalt is going to be part of the lithium-ion battery future, and how their water cleaning ion exchange-based technology will, play a substantial role in the rest of the world. So suddenly coming out with this news release about Scandium and a collaboration deal with Panasonic, something's going on. It looks like Scandium's going to become important. Now, I say there's no stake to this news release because it simply says that Cleantech will sell up to 5 tons of scandium oxide per year, and Panasonic will decide each year what it is that it will buy, which can be zero, and it can also terminate this 10-year agreement if it so sees fit with notice, and it doesn't really clarify what notice is. So this is not a true take-or-pay offtake agreement, and you're never going to actually see something like that for a commodity like scandium, which there's no primary scalable supply. If you fail to deliver it, your customer can't force you to give you the money and buy or secure it from somewhere else and deliver it in that manner. Everybody is just out of luck. So any sort of offtake deals are going to be of this sort of vaguer nature. So, but the other problem that Cleantech has is that because it can't go back to the higher grade, smaller footprint scandium-rich deposit, it's in no position to produce any scandium oxide until it actually has Sunrise in production. Now, the electric vehicle market has sort of sagged. China got rid of its subsidies this year. That they're now talking that the sales this year may be only marginally bigger than they were before, and that's a bit of a shock because China has made the electrification of its vehicle industry a strategic priority because they want to wean themselves off dependency of oil imports as a transportation fuel, and it's easy to see why. They have plenty of coal-powered electricity to charge the batteries in their cars. But the whole sort of electric vehicle mania really stalled in the last year and a half, and of course there was oversupply of lithium and the cobalt. There was plenty of supply, so the prices have come way down, and the whole battery metal space is pretty stalled. And in the case of the lithium-ion battery, all the concern about where we're going to get our cobalt from has resulted in a lot of thrifting R&D, so that the amount of cobalt required in a lithium-ion battery is considerably lower than it was before. And ironically, it is nickel that has benefited. There's now more nickel required. So the hope for clean tech is that next year we start seeing a revival of interest in the electric vehicle market as the Europeans start getting serious, rolling out their electric vehicle fleets, and that hopefully China turns around also, and that we get stronger nickel prices in 2020, and also get cobalt maybe back into that $20 to $30 range. But that still doesn't put them in a position to deliver a Scandium to Panasonic or whomever else they do such a deal with, because it will take a lot longer to fully permit and build a billion dollar nickel cobalt sulfate chemical plant at their Sunrise project. So the problem for clean tech is, although it has the richest scandium deposit, it can't do anything with it, and for the lower grade byproduct scandium, it can't deliver that until it has the big Sunrise nickel cobalt operation underway.
We'll have more with John Kaiser right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with John Kaiser. John, would it make sense for clean tech to acquire Platina Resources, whose Owendale deposit is next door, or even Scandium International, whose Ningen project further south already has a mining lease?
On the surface, it would make a lot of sense, because the Owendale scandium-enriched deposit it's part of that whole system in that area. It's just northwest of the Sunrise system. Platina did complete a definitive feasibility study. It was based on the flow sheet that Scandium International used in its PEA. But the problem that Platina has with Owendale is that it does not have any water rights in the area. All the water in this area comes from aquifers, unlike in the Ningen area where it's all drawn from rivers that go through that area. And the predecessors who owned the Sunrise project, they tied up the water rights a long time ago. So Cleantech owns all the water rights in the region. And so the mining scenario that Platina came up with for Owendale involved trucking raw ore running 300 to 400 ppm scandium 80 kilometers to a facility to the south where they did have access to water. And of course that makes this project probably not so easy to permit, because you're going to have tailings in a separate place, or maybe even have to truck them back. And but if Friedland were to acquire Platina, and Platina is in essence for sale because they stopped doing any meaningful work on the Owendale project, and in fact have raised money to farm into the Moonlight VMS project from a junior that's listed on TSX Venture that trades at 2 cents. And this project's about 3-hour drive from my place here in the San Francisco area. So they've clearly gone back to exploration and have no interest, and theoretically Owendale is available for clean tech to acquire. However, Owendale doesn't yet have a mining lease, and they also do not own the surface rights. And in this area, the land is considerably more fertile than in the Ningen area. It will probably be classified as agricultural land. So even if Friedland owned it and was willing to divert his water to that project and build it as something parallel to his much bigger scale nickel cobalt Sunrise project, he might have difficulties getting the surface rights or paying a decent price for them. But the other issue is he has to bring the water in from quite a distance via a pipeline. So buying Owendale to put that into production sooner than Sunrise, you would have to spend the capex on bringing the water in. So that's not really a viable alternative. Acquiring Scandium International makes a lot more sense. They did lose their mining lease earlier this year when it turned out that the incompetent New South Wales permitting department had indeed lost the farmer Owen Carter's letter saying that the eastern part of that mining lease, where he still owned the surface rights, qualifies as agricultural land. He had submitted that in 2016, hadn't noticed that it didn't show up in the 30-day comment period, only noticed it when the mining lease was granted in 2017, went to the New South Wales Permitting Department and complained, what about my letter? They couldn't find it, looked around, told him to take a hike, and then in October last year, somebody found this letter in some completely wrong file, basically a mailroom order error, and brought it out, and all of a sudden, we have a big problem. And they ended up hiring a consultant to go out there and assess whether or not this actually is agricultural land, because the permitting department can rule that it isn't agricultural land, and then it would not have mattered at all that he wrote the complaint letter. But because they had screwed up, they wanted an independent opinion. So this independent consultant hooked up with the farmer and had him drive him all around the area and explain why it's all wonderful agricultural farmland. And so he wrote his opinion saying that, yeah, indeed, this is agricultural land, which of course the fact that he had used a non-independent source for all his information kind of blew that up, but it put the New South Wales people into a pickle. So they ended up canceling it, and so the Scandium International reapplied from the western part where all the infrastructure is and where at least 7 years and probably many more years of production is planned. And the New South Wales Department granted the new mining lease on the western part, and now they're still waiting. Everybody's still waiting for them to rule on whether it is agricultural land. And if that happened, then Scandium International will have to sit down with the farmer and say, okay, what do you really want for this land? Because if the farmer sells this agricultural land, the new owner can do whatever they want with it. They don't have to keep this land. The whole point of the strategy is prevent eminent domain from enabling SCY to acquire this land at fair farmland market value down the road. So all of this kind of really undermined the momentum of Scandium International. They were not able to finance during the uncertainty of the first half. And of course, the junior resource sector bear market really got pretty bad later this year. And so they tried to finance, but have been unable to finance and are now basically out of money. The company has had nothing to report about its letter of intent strategy of helping various end users test master aluminum scandium alloy and make their components. They haven't been able to convert any of those into something that might look like an off-take agreement. They've been completely silent, and the CEO, George Putnam, is running around now trying to find somebody who will finance the company. And the big shareholders seem to have taken a back seat. And the biggest shareholder is the Evanson family. Peter and Chris Evanson. They own about 72 million shares. They bailed out the company in 2014 when they loaned sufficient money to take out an existing loan and prevent the asset from being confiscated as collateral. They eventually turned it into a 20% property interest, and in 2017, when the mining lease was granted, they converted that into a 20% equity stake. But I don't think they quite understood how long and difficult it is to develop an offtake market for something like scandium that doesn't have an existing market. And I suspect there's some sort of standoff going by, because it makes no sense that the big shareholders are silent in the background. Anybody else looking at this would say, well, why don't those guys? It's their job to raise the money. They're the ones who stand to make the most from it. And it's been sort of a sorry period for the minority shareholders, because they don't know what's going on. There's nothing they can do, and the stock is sunk below a dime. But this creates a window of opportunity for Robert Friedland and Sam Riegel of Cleantech, because here you've got a company substantially undervalued. Cleantech, it's not really undervalued, because at the moment the Sunrise deposit isn't worth anything at the nickel cobalt prices we have, but if you assume they're going to go back up, it will end up being worth substantially more. But they have $80 million still in the treasury, so they could start building stuff. They could do that melt shop that the management has talked about doing to make more master aluminum scandium alloy to help develop the offtake market. And with all the weary shareholders, stocks 9 cents, 10 cents, Cleantech, which at one point was $1.80 and was down 90% from its peak, it's now climbed back over 20 cents. Doing a paper deal to absorb Ningen. They would get the expertise of all the people that are working for Scandium International. They would be able to bring the Friedland brand to the story, and they'd be able to develop this right away, because the mining lease is already in place. Water rights are not a problem to get in this area. So, yeah, that would be the sort of no-brainer thing, but of course nobody wants this to happen, because they know Robert Friedland doesn't really do deals that benefit the other side in any significant manner. So it becomes a question of, well, what does the Evanson family want to do with its 72 million share block? Do a lockup deal for some sort of paper bid by Cleantech, or will somebody else ride in and become a big stakeholder, do a big financing at 10 cents and get this ship going again? So it's an interesting period. This Panasonic news release, although lacking substance in itself, it is like raising the scandium flag back up the pole. It means that Cleantech is on the move. They can't do anything really internally with their scandium resources, but they have the muscle to consolidate the space and get this scandium lightweighting story on the road.
We'll have more with John Kaiser right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with John Kaiser. John, somebody dumped 1 million shares of FPX nickel this week. Is the Dakar nickel project still far from being viable at current nickel prices?
Well, Jim, I've followed this story since 2010, and the stock was around 10 cents at the time. And then that whole cycle to 2013, it went all the way up to a couple bucks. Cliffs spent $22 million US to deliver a PEA, but by the time they did that in 2013, the nickel price had gone down significantly. It was no longer around $9. It was, falling towards $6. And the PEA said, based on this 13% concentrate, that's basically going to be feedstock for a stainless steel mill, and the payability of only 75% for that, you're going to need $10 plus nickel for this to be worth developing. So they vested for 60%, didn't bother going higher. Then Cliffs itself came under attack from a cranky hedge fund, which had been treating it as an iron ore proxy, and the iron prices collapsed, and they kicked out the management of Cliffs and sold all the assets, and the it was called First Point Minerals at the time, now called FPX Nickel. They managed to do a deal where they bought back the 60% from Cliffs for about $5 million US, and that was funded by a mystery lender who took the project as collateral. It was a 5-year loan, and then the company went through a very interesting journey. They looked at the PEA and tackled a number of things that they felt were inadequate about it. One was, because it's a very large homogeneous ore body, 2 billion tons of about 0.12% Davis tube recoverable nickel, Cliffs had just assumed we're going to do this average grade every year, no ore schedule where you mine the higher grade stuff in the beginning. But they had seen that in the southeastern part of the property of the deposit, there was a higher grade zone. So they spent money properly drilling this off and putting together an updated resource estimate. And so now, at least internally, they have an ore schedule which would put higher grade material farther up front rather than just the same material all over. And in the discounted cash flow model, cash flow up front is worth more than cash flow later down in later years. Now, another thing that they didn't like was the 13% concentrate, and Cliffs had used a magnetic separation followed by gravity to produce the concentrate. Now, the magnetic separation got out all the awaroite, which is the key mineral. It's a natural stainless steel alloy between nickel and iron. But the magnetic separation also got out all the magnetite. So a good chunk of the concentrate was magnetite, and gravity, because magnetite and awaroite have similar densities, not identical, but close enough to make really getting the magnetite out of it. That's why they ended up with a 13% nickel concentrate with half of the iron in the thing coming from the magnetite. So the company explored different avenues of how to create a better concentrate because they weren't going to be paid for the iron, whether it's in the form of the awaroite or in the magnetite. And they explored the idea of flotation. So they're already using magnetic separation to reduce the what's going to be 120,000 ton per day crushing, grinding, mining operation down to something that would be 10 to 12,000 tons per day flotation. And flotation is normally used to separate sulfides, but it turns out it also floats awaroite, even though it's not a sulfide, it's an alloy. But of course the magnetite's an oxide, so it disappears during the flotation. So they were able to get the concentrate up to about 65% nickel. 30% of that is iron, and then the other 5% is other stuff that they were unable to get rid of. So now they had a concentrate whose payability was going to be better than the 75% for the 13% con. You also had a lower transportation cost because you were moving, a concentrate that was 65% with the valuable nickel rather than something that was 13%, which is 25% of the new one was only 25% of the weight of the original one. And so they've been doing all these numbers, optimizing the ore schedule, coming up with a new circuit. It turns out that adding a flotation circuit at that thing and is the same cost as doing the gravity. So they got rid of the gravity. The one sort of negative thing that they encountered was the tailings storage facility. Cliffs had only assigned $80 million for that, and they looked at this and said, this thing, 99.5% of this deposit goes back as tailings, and it's going to be a 30 to 40 year mine life, and I don't think in the wake of Mount Poly and those dam disasters in Brazil that this thing has been properly engineered. So they've gone in there and had third-party consultants redo the engineering, and now instead of an $80 million cost, they have a $300 million cost. So they're figuring the capex, instead of being $1.4 billion US, which was Canadian at the time because the Canadian dollar was at par with the US dollar, is going to be up there at $2 billion. So every year they're looking at this, they're looking at the nickel price, thinking, we're going to need a nickel price of $7 to $8 even with these changes. And this year we were getting very close to that $5 million debt being due. They were able to do a deal where Peter Bradshaw, who has been the backer of this, the founder of this company for ages, he put up $3 million US of his own money, and they converted it was used to replace half of the debt from this private party, who now only has $2.5 million, $3 million US debt against the asset, and its deadline from 2020 has been extended to 2022, and Peter's loan is now 2025. So the danger that in an ongoing bear market, they lose the Dakar asset, that has gone, and they've done some additional financing, and the stock's been doing reasonably well, 11 cents to 15 cents range. So the selling activity that we saw, it was somebody who bought 1 million shares in sort of June of 2018, almost up to 15 cents level, and don't know why, but something prompted this to be liquidated at the bid. It came out, somebody bought it, and it prompted me to contact the company and wonder what's going on. Is this thing dying? And I found out something that they're working on that's really interesting. Back in October, they started a metallurgical study involving pressure leaching. And their idea was, right now we're stuck selling a 65% nickel concentrate, which is of interest only to stainless steel makers as a feedstock. But is it possible that we could get the iron out of this and maybe make a nickel sulfate? Because nickel sulfate is the form that the battery market needs. Now, nickel sulfate can be made from refined nickel, the kind that ends up in the LME warehouses. It's not possible to make that from the nickel pig iron that comes out of the Philippines and Indonesia that the Chinese throw into their blast furnaces. But it is also what the Cleantech wants to produce at Sunrise, make a nickel sulfate directly from the solutions. And so they said, well, we can do a much smaller scale, 100 to 200 ton per day autoclave for this concentrate, and possibly we can separate the iron from the nickel and then use solvent extraction to produce a very high purity nickel sulfate. So they are now waiting for the results of a study being done by Sherritt on a small bulk sample of this concentrate to see if it is feasible to make a nickel sulfate constant product. And if that is the case, then this asset becomes very interesting to a much broader potential audience, because then it's not just for the stainless steel mills, then there's also possibly a long-term stable supply of nickel sulfate for the electric vehicle battery market. So the company is actually at a turning point. I'm very much more excited about it today, and I think it's going back to like 2010 when this was a very exciting concept. At the time, we thought they might find many more such deposits and control them all. Turns out this type of deposit is pretty unique. The company will be in my session at the Metals Investor Forum on January 17th and 18th. They are showing signs that we're going to do an updated PEA in 2020. The market wants to know what is the cost structure following all this optimization and flotation changes that you have done. And there's also the possibility that we will see a nickel price become stable in that $7 to $8 a pound range, that they feel this is what we need. We don't no longer need $10 plus. Nickel supply is still in deficit. The Indonesians had granted a waiver on the raw ore export ban to those Chinese companies which had agreed to build HPAL processing facilities for nickel laterite ore in Indonesia. But they decided that some of them weren't moving quickly enough, so they shortened the deadline for this waiver from 2022 to January 1st, 2020. And initially this caused nickel to run up over $8 this year, but then they all scrambled to mine this stuff as fast as they possibly could and ship it off to the warehouses in China and get it out of Indonesia before Indonesia puts a stop to this. So we saw nickel prices fade back to $6, but come the new year 2020, this high speed mining of nickel laterite raw ore for the nickel pig iron market, that's going to come to an end in Indonesia. The Philippines really, they've been high grading like crazy ever since Indonesia introduced this ban in 2014. So they no longer have an ability to ramp up supply. So the nickel market is likely to strengthen. And if the electric vehicle market starts strengthening again, continues to grow as the initial expectations were, then we will see nickel stabilize in this higher price range. And if the PEA comes out with numbers that suggest it's worth developing at a nickel price somewhere between $7 and $8, and the nickel price is in there, somebody's going to want to acquire this project because it's going to be a 30 to 40 year mine life in a stable jurisdiction close to infrastructure. And if, as a bonus, they can make nickel sulfate, well, then this will be quite a star in 2020.
John, all the best of the season to you and your family.
And to you too, Jim, and to our audience out there.
I've been speaking with John Kaiser, his website, kaiserresearch.com. I'm Jim Godden.
Comments made on Discovery Watch are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howstreet.com. Discovery Watch is a production of How Street Media Incorporated.